Introduction to the blockchain phenomenon. If you work in finance, you have no doubt heard about the blockchain. Even non-bankers have become familiar with the terms cryptocurrencies and distributed ledgers, often terms they even have an opinion about. But how did a back-end technology for monetary transactions end up with such fame? It all goes back to the global financial crisis of 2008, when people around the world started to lose faith in centralized institutions. Profit-hungry banks had gambled away their savings, regulators had failed to restrain those Goliaths, and central banks had run their money-printing presses at full speed. Amidst this turmoil, a short, mysterious paper appeared on the internet, penned by pseudonymous Satoshi Nakamoto. The paper outlined the world's first real cryptocurrency, Bitcoin, which enabled an alternative financial system. A system that did not need banks or intermediaries to transfer money, a system in which governments and regulators had no say in approving transactions, and a system in which no central authority could mint new money and cause inflation. All these processes became possible with computer code alone. Paying trusted companies such as processors or notaries was necessary no more. Every time the value of cryptocurrencies soared or fell, the media raved. The fact that up to this day nobody knows Satoshi Nakamoto's true identity has done its part to fuel the hype as well. Yet as the shortcomings of Bitcoin and its peers become clear, the spotlight turned to the more promising technology in the background, the blockchain. In this series of videos below, I will cover, amongst other things, the key concepts of blockchain technology, including the areas of finance where it is expected to be a true game changer. I will also cover whether the technology is really 100% secure, as is often claimed. Key concepts of the blockchain. Very broadly speaking, we can say that the blockchain is a platform which can run applications such as cryptocurrencies. Those systems offer unprecedented security levels, even without having to trust third parties. But what is it that makes the blockchain so different to current payments and transaction systems? Why is everybody calling it a paradigmatic shift? Let us start with the distinction between cryptocurrencies and the blockchain. A cryptocurrency is a digital asset class that can be used as a medium of exchange, instead of government-issued money. Put differently, Bitcoin is digital gold. You can store value in it, and you can trade it. The revolutionary technology in the background that enables the exchange of such a currency is called blockchain. While cryptocurrencies are impossible without its back-end technology, the blockchain is possible without cryptocurrencies. You can use it to transfer fiat currencies such as the British pound or the US dollar, or you can use it to track the authenticity of diamonds, to prove the origin of food, or to build a tamper-proof election system. Because the blockchain does not only allow you to exchange value, but also to distribute information in an autonomous and secure way, this is why it has attracted interest outside the world of finance as well. Technologically, the blockchain's fundamental difference to the current payment systems and databases more general is its distributed nature. The keyword repeated here over and over again is distributed ledger technology. Sets of records are not kept and updated on a centralized server, but stored on a computer network that is distributed across the globe. It is a network based on peer-to-peer or P2P technology. What you have to understand about monetary transactions is that if they are not conducted directly by cash, meaning coins and bills that are handed over, they have to be recorded in something called a ledger. In the past, a ledger used to be a physical book indicating who owed what to whom. Today, it is a computer file of some sort. Banks each have their own ledgers, and they need trusted third parties to make sure different ledgers of different banks are all in unison after a transaction. It is the only way to ensure money is not simply multiplied when being sent electronically. Blockchain is revolutionary in that it works with one ledger only. This means there is only one version of the truth, and this truth is continuously distributed to each computer in the network. Those computers and servers are called nodes, and their task is not only to keep a copy of the record, but to verify whether the new entries that are added to the existing records are legitimate. You can think of a blockchain application in terms of an online, collaborative Microsoft Excel document in which everybody in the network can add lines denominating a transaction. Rather than having a local copy of the file on each computer and having to constantly keep them in balance, there is only one file that is being updated in real time. Furthermore, there is no centralized administrator validating the changes. But unlike in a collaborative Excel file, The master copy is not stored somewhere on a server. Instead, the file is stored on every computer in a network. Lines of transactions are bundled into blocks, and as soon as this new transaction block is confirmed by the participants, it is saved. The new block is linked to the preceding chains of blocks, which gives the blockchain its eponymous form. The link between the blocks makes sure that you cannot change a transaction in the past without altering all subsequent transactions. The copy on each computer is updated. How participants agree on the transactions is a matter of severe dispute. This consensus process is different with different blockchains. Centralized versus decentralized. Generally, there are two major types of blockchains split along the lines of their consensus mechanism. Bitcoin and most other cryptocurrencies use so-called decentralized blockchains. In this setup, everybody is free to join the network. If you join the network, you supply computing power in exchange for being rewarded with the currency of the blockchain, say Bitcoins. This makes decentralized blockchains entirely autonomous and open networks. Yet on the downside, the high number of participants, currently more than 10,000 in the Bitcoin network, causes scalability problems. Bitcoin can do 7 transactions per second. The Visa network handles 1,736 transactions a second in the US alone. Moreover, decentralized blockchains have a serious energy consumption problem. The Bitcoin network burns as much energy as the entire country of Ireland. The heavy IT equipment needed to mine cryptocurrency has to be trashed every 6 months. Thus, banks and companies have come up with the idea of centralized blockchains, in which they limit the autonomy of the network by deciding who the participants will be. Hence, the creed of openness is sacrificed for much faster and cheaper processes. This dichotomy between centralized versus decentralized, or closed versus open blockchains, is also reflected in the terminology. When you talk about centralized setups, you will mostly hear the term DLT, or distributed ledger technology, as many pundits still refuse to accept centralized versions as fully fledged blockchains. And indeed, there is a crucial difference, as centralized blockchains still rely on the least one trusted authority. On the other hand, centralized versions are using most blockchain concepts and offer most other advantages of blockchain technology. Hence, I believe it is still adequate to call them blockchains. But regardless of the degree of centralization, blockchains are often equated with distributed ledgers. Yet this is not entirely correct. The actual distributed ledgers are the protocols sitting on top of the blockchain. Thus, the blockchain itself is not the ledger, but the mechanism for transaction validation, i.e., to reach the consensus between the different nodes in the ledger. But even within the prototypical decentralized blockchain group, there are various validation mechanisms. In the proof-of-stake mechanism, for example, nodes with more equity in the blockchain have more decision power. But the most prominent model is certainly proof-of-work. This is also used by Bitcoin. In this setup, transactions are validated by burning massive amounts of energy and computer power. If you want to understand in more detail how proof-of-work achieves unparalleled security standards, even without a trusted third party, click this link. Smart contracts. Besides being used for database-like applications, blockchain technology can autonomously perform more advanced processes. This is made possible by so-called smart contracts, which are also known as the second generation of the blockchain. Smart contracts are not necessarily contracts in the legal sense, but rather computer protocols that sit on the blockchain. With them, programmers can define what-if scenarios that autonomously execute the coded logic. You can also call them event-driven programs that determine how digital assets will be transferred. As this all sounds very abstract, let me illustrate smart contracts with a real-life example. A bank might code a contract to lease a car to its customer. In this case, the bank would specify that the car will lock itself automatically if the blockchain does not register an incoming payment every first of the month. This way, the seller of the car ensures that the buyer will have a strong incentive to pay the installment. With a smart contract, you can also determine at which price point your shares should be sold or bought automatically. A major application field for smart contracts is insurance. Say your flight gets delayed and you are entitled to compensation. Your insurer can anticipate that scenario and write the smart contract for the blockchain that immediately releases payments to your account once the airline reports the delay. There is no bureaucracy and no leeway for the airline to refuse to pay. But this example also illustrates the challenge for smart contracts, namely how do you ensure that input from the world outside of the blockchain is correct and authentic? Who has the authority to feed the flight delay data into the blockchain? Where does the blockchain take the information on stock prices from? These interfaces to the non-blockchain world are known as oracles. A concept often discussed along smart contracts are dApps or distributed apps. dApps are programs that are executed in parallel on all nodes of a blockchain without the need for central authority. This is more expensive and slower than the traditional client-server model, but a quantum leap in terms of data security. dApps are connected to the blockchain via smart contracts. Most smartphone apps you can think of could also be run on a decentralized network. Therefore, many commentators have dubbed dApps a possible Uberization of Uber. Summary. To sum up what the blockchain is, it is a computer protocol enabling distributed ledgers and promising almost instantaneous and near-free value transactions. Money and assets can be moved without a central authority. Validation is performed by a peer-to-peer network without the need for intermediaries to authenticate, clear, or settle transactions. And blockchain's next development step, smart contracts, can automatize a series of blockchain-based actions and thereby have a disruptive impact, not only on payments, but the economy as a whole.